All right. Good evening, everyone. Good evening. Thank you very much for joining Wealth Mindset and Real Estate Investing Virtual Meetup. My name is Chris Price. I'm the host of the Wealth Mindset and Real Estate Investing Meetup, and I'm also the CEO and co-founder of Red Fox Multifamily. This evening, we are going to be joined by our guest speaker, Mr. Alvin Scioneaux Jr., and he's going to talk about bridging the wealth gap, which I think everyone will find very, very interesting and intriguing, and hopefully, you'll take away some important gems from what Alvin will be providing this evening. But before we get into Alvin's presentation, let me take a moment to just do a little bit of a commercial break for our sponsors today. So, the Wealth Mindset and Real Estate Investing virtual meetup is sponsored by Red Fox Multifamily, which I'll get to in a moment. But here at the Wealth Mindset and Real Estate Investing meetup, it is open to all who are invested and interested, I should say, in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living and they have discretionary income to invest in real estate for its proven wealth building power, but they don't necessarily have the time, skill sets, network, or to do it at speed and at scale. And so this meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. The meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate through passive investments. And it's sponsored, as I mentioned, by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios and add passive income and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities we get to access from our trusted network of top operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands-off, allowing investors to add passive income, build equity, and save on taxes, all while being in an investment vehicle that's backed by a hard asset. So that's enough about who we are. Really quickly here, just logistically, we want you to mute your lines when you're not speaking. Hold your questions to the end of the presentation. This presentation is being recorded. Also, just please make sure that you are able to recognize that the fact that this material does not constitute an offer or a solicitation to purchase any securities. And please note that this is for information purposes only and should not be considered or construed as business, financial, or legal advice. And one other point of logistics, for those of you who I'm not connected with watching it live now, or that will be watching the playback on a recording, please reach out to me to connect. The best way you can reach out, my email is here, chris@redfoxmultifamily.com, or you can scan the QR code and get my contact information to reach out to me that way. So I look forward to hearing from you. So without further, our agenda tonight is pretty straightforward. I'm gonna, in a moment, introduce our speaker. I'm gonna also take a moment to, pass it over to our speaker tonight, Alvin, so that he can walk us through the presentation and help to educate everyone that's taking this in on the topic of choice this evening. We'll have a little bit of Q&A, and then, of course, if there's an opportunity, we'll be able to have some virtual networking. So without further, let me go ahead and introduce our guest speaker this evening. So Alvin Scioneaux Jr. has a passion for helping current and former athletes build passive income through real estate investments. Now, before I read this bio, I gotta say, I had an opportunity to meet Alvin actually earlier this year at Raise Masters up in Louisville. Kentucky, right at the beginning of the year, and we had some mutual connections over there. But Alvin and I had a chance to speak briefly and just kind of just get connected and learn a little bit about each other. I began to just really connect and build. And one of the things that we discussed, I remember, is hey, maybe there's an opportunity for us to collaborate or partner one day. And lo and behold, here we are, almost a year later, where Alvin was kind enough and gracious enough to provide his time to educate the community here at the Wealth Mindset and Real Estate Investing Meetup. So I'm very grateful for you, Alvin, to be here. So let me go ahead and read the bio formally. Just wanted to provide my little personal anecdote there. So Alvin is a multi-talented individual from St. John Parish, Louisiana, with a master's degree in mechanical engineering. He spent 8 years as an aerospace engineer. He also excelled in athletics, playing in the NFL as a linebacker. After football, he became a fitness coach, a model, and an actor. Alvin is a public speaker and a member of the National Society of Black Engineers. He's deeply involved in philanthropy, runs a multi-million-dollar real estate business, and is part of Omega Psi Phi Fraternity Incorporated and the NFL Players Association. His journey from engineering to sports to diverse career roles reflects his dedication and commitment to giving back to the community. And I mean, Alvin, man, what an amazing bio, an amazing story. I can, speak from experience and someone who tried to play professionally, but didn't have the skill or to be able to make it to the level that you made it to. It's just exceptional. Your athletic accomplishments, but then when you look at your academic accomplishments and all the things that you've been able to do, I'm struggling to find the words to put together about how you even were able to accomplish all those things, and you're still at it, still going. So amazing background, man. I'm looking very much forward to hearing you present today, and I'll turn it over to you so that you can share with the team.
Yes, yes. So definitely appreciate Chris. I will second that and say we definitely had a good time, good conversation out in Louisville. So yeah, looking forward to dive a little bit more. Let me know if you can see the screen.
Yeah, we got you.
Okay. Looking forward to dive a little bit more in just in general real estate investing and probably the one component that created the wealth gap and how we can all make sure we're on the upper side of that gap in general, as well as some real estate investing aspects that I've gathered over the years. So uh, we'll dive right into it. So this is my company, Financial Athlete Capital, focus on athletes as well as other professionals to help bring them real estate investment opportunities to create passive income and grow their net worth. So I always like to start off with what is your why? Like, what's your purpose? Like, what are you trying to get out of life? What are you trying to do within life, the value, the impact you're trying to bring, right? So is it really the debt? I want to get out of debt. That's really been holding me back. A lot of people, especially in today's world, school debt is the largest, fastest growing debt there is in America. Especially if you go to professional schools, you can be $200,000 in debt. So, or is it, raising your family, got your, maybe your wife or your husband or your kids, you want to create that family legacy to have your kids get a leg up in life as opposed to starting at ground zero or even below ground? Or is it just retirement? I'm trying to live the good life, trying to go to the Caribbean every week and live it up, and not have to worry about your income or, simply financial freedom, doing what you want, when you want, where you want. I know Chris and I was talking about that a little bit earlier. So, I basically already gave some insight to that question. How do you define your financial freedom, having that ability to be free and do as you so please? So whenever you get that why, I want you to really, really define and plant that deep down into your mind and your souls, because that's going to be what will carry you forward past anything that can happen or will happen in life, right? So now we have that why. Now, how do we act on that? How do we grow that thought seed of our why to blossom? it's going to start with a change of mindset. You know, I always say everything that ever existed in the world started as a thought first. You know, the laptop you're in, the phone, the house, everything in the world that has been built, right? And sometimes it feels like an uphill battle. Life, there are ups and downs, you know, especially the pandemic, you know, everybody, unemployment, things going crazy. The market right now is still in a lot of volatility, especially in real estate. So sometimes it feels like an uphill battle. However, we have to really understand that the thoughts that got us to where we are currently, they won't those same thoughts will not be able to get us out into that next level and to level up, right? So I always say what got you here won't get you there. You know, so that same old thinking will we need to change that if we want different results. Going back to the definition of insanity, right? Keep doing the same thing, expecting different results. You know, that you might have some insanity like aspects. So we want to fully understand that so that we can change our thinking, change our actions, and thus change our results, which will lead to a changed life, right? So, you know, we got our why and we got our mindset. That's always foundational and what I like to start with. So I'm gonna go a little bit through my why and my mindset shift over my career, just to give you a brief overview from New Orleans, Louisiana area. So food, culture, music, that's you know, live it up, have fun. That's foundational. That's foundational for me on a why and a mindset level of if you don't enjoy what you're doing, then we're not doing it. So from there, I had a athletic scholarship to Wofford College out in Spartanburg, South Carolina. I studied physics and math. You know, athletics and physics and math don't really go together, but just know I had very little social life. So, you know, going from that, I had a lot of success in football, and I was a physicist for a little while as well. And then I got the call. Graduated in 2013, so going into 2014, got the call from the Los Angeles Chargers. They wanted me to come out, and it was great. Being a professional athlete, making it to that level. You know, I didn't think to myself I would even make it to that level, but going back to the mindset, you know, once I seen some success in college, became a All-American in college. Like, okay, you know, I had to start believing in myself to make it to that level, and eventually I did. Um, it was great, you know, during that time period. However, it was simply one game, one quarter, one play, one move, and bam, blew out my knee, tore my ACL, tore my meniscus. It was against the Cowboys. So I was in with the Chargers in 14 and 15. And then I did 1 year in CFL with the Edmonton Elks in 2016. That kind of was short lived. And just like that, as fast as I started my professional football career, it was over. You know, here I am, 25, and we got to pivot. You know, we got to figure out a new why now. I got to figure out a new mindset of where we want to go. I ended up getting my master's in mechanical engineering from San Diego State, and became an aerospace engineer while I was investing passively in real estate on the side. Was an aerospace engineer for about 8 years until earlier this year. I just went full time in real estate. My real estate income was surpassing my engineering income, and I was, you know, getting paid well as an engineer. So again, another pivot in my career, in my life, changed my why, changed my mindset to go down this new path, right? So currently financially free with millions of dollars in real estate. Actually, just closed today on another 8 unit in Hollywood, California. So it's been great thus far. So, you know, that's just to give you a little overview of, you know, how my why shift and mindset has shifted over this entire time period. So, but we're gonna go dive a little bit deeper into some of those aspects. So let's think about employee versus investor. You know, that's probably one of the biggest mindset that have created the wealth gap today. And it will determine which side of that gap you're on. So everybody familiar with this brand right here? Y'all know Coca-Cola, you know,
That's yeah.
a top 50, you know, brand in the world. Now, in regards to Coca-Cola, anybody know who's the CEO, the top employee at Coca-Cola? It
No.
is James Quincy. My boy James had last year had a total compensation of $23 million. James getting paid. Now, James is the epitome, the top of the employee food chain or ladder at Coca-Cola. Now, anybody know who's the top investor in Coca-Cola? You probably I'm sure you heard his name before. He's very, very well known investor, Warren Buffett. He actually owns 400 million shares of Coca-Cola that pay him $1.84 per share. Now, if you do the math, that's well over $700 million just in dividends. So we got the top of the investor ladder and we got the top of the employee ladder. Somehow, some way, still, um, Warren Buffett makes over 50 times what James has made as an employee, right? So that just to give you an example, a quick example of how thinking from an investor mindset, you can get so much farther ahead in life as opposed to just thinking with an employee mindset. And nothing wrong with having a W-2 job or anything of the sort, but you want to, as you allocate your funds and your money, you want to think, how can I become a better investor with these funds, right? So that's very, very much so foundational from a mindset standpoint. Now, we established that we don't want to think as an employee, we want to think as an investor. So the natural next question is, okay, where do I invest that? Where do I put my money since I'm thinking like an investor now? So different money storage options. A lot of people, they have a checking and savings. The last place you want to invest your money or store your money, as you can see, checking, you're not really getting any growth. In savings, you're getting 0.03% on average, which won't get you much. Even a high yield savings account, you might get 1%. So you're not really doing much in just leaving it in the bank. Other options is 401ks and stocks. A lot of people invest in retirement accounts and the stock market. Now, the thing with this is you see 5% growth here. A lot of people, when they look at their retirement account and look at the stock market, they see 8% or they see 10%. So 8% is actually the gross return, and 10% is the gross return with the dividend. A lot of companies, even the S&P, even the top 100 companies all of them do not have dividends. So you can't just automatically count on getting a dividend. So yeah, 8%. And then once you factor in inflation, once you factor in your advisory fees and other fees, you're really at, on average, 5%. Now, think that this will make complete sense to you. I'm sure you probably heard this phrase before. It's not how much you make, but how much you keep. Right. It doesn't really matter if you average 8% or 10%. If that's gonna get cut in half, then you're not seeing it. It really doesn't matter what the gross return is. You always want to look at net. And when we compare net returns, as you can see, single family real estate is really not that much better at all because there's only one tenant. But when you look at multifamily real estate in particular, the gross return on multifamily real estate has been 15%. The net return is actually 12%. So, and another quick stat to tell you, the average investor in the stock market actually only gets 3% because you look at all the different fees and inflation, and then you have to realize most people are not 100% invested in stocks. They have 40% bonds or 30% bonds. So that's going to drag their return down even more. The average person that's just leaving their money in the stock market is really only getting 3%. And guess how much inflation is? 3 to 4% as well. So you're really not getting ahead by much. You're really not getting ahead by much. So you definitely want to diverse into different asset classes that will get you ahead and offer a better return from a buy and hold standpoint.
Yeah, and Alvin, you're being generous with that inflation number, right? Like a lot of people saying in these days it's a little bit higher, right?
Yeah. So in 2022, it was 8 to 10%, or 20 the past 2020 to 2022, those couple of years, it was 8 to 10%,
Right.
right? So we seen during the pandemic houses. That's the one thing about having assets like real estate. When inflation is going crazy, guess what you think your real estate investments will do? Go crazy with it. Like, it will follow the curve of actually inflation. Whereas if you have just money, your money purchasing power is decreasing in value, and any of a lot of your paper investments like the stock market are not growing, or not having that same purchasing power as a physical asset like real estate, right? So, those are just some key points I want to just throw out there real quick just to understand. So now we see there's a reason that 90% of millionaires were made through real estate, right? Because it's for one, it's not going to zero. It's a physical asset, and you can actually get paid 7 ways from real estate, whereas in the stock market you're only paid 2 ways. So stock market you're only getting paid through dividends and appreciation, whereas the real estate you can pay 7. We'll probably save those to the. I'll tell you those at the end. See if anybody knows. Put them in the chat. Little quick pop quiz, but for so we established the different avenues we can invest in. So from a real estate investor requirements, we have different active opportunities: house flipping, fixer-uppers, short-term rentals. Now, these will require a lot of direct involvement depending on how much time you have, how much knowledge and bandwidth you have. A lot of people, if you're working 40, 50, 60 hours a week, you probably don't have another 40, 50, 60 hours a week to put in a real estate development. A lot of decision making. You have to figure out what contractors, what to upgrade, what not up to upgrade, when to implement systems, the time commitment, as I mentioned. If you're working a full-time job, you probably don't have enough, another 40, 50 hours a week to dedicate to your real estate investments. Of course, there's risk exposure. If you're the one purchasing a property, you're on a loan, or if you're raising money, you are the one that is will be responsible or on the hook for paying off that loan as well. So these are all things you have to consider. And of course, I mentioned expertise. Each one of these within real estate is a very niche or a unique aspect of real estate. So you want to put in a lot of time to get up to speed and become an expert in that general area. So, but if you don't, then that can be an actual negative to you and hurt you in that regard. So questions you really got to ask yourself: how much control do you want? Do you want to be in control of every single thing and making all the decisions? Or what kind of skills and personality do you have? Do you have the outgoing, or are you going to networking and conferences and meeting with different vendors and of course property management contractors, lenders, things of this sort to make those connections? How much time do you have to really go out and invest that time to acquire all of those connections? And how much risk do you want to take on, as I mentioned prior, being being on the hook for any loan payment, any liens on the properties? These are things that you want to keep in mind from a decision-making standpoint, and also scaling and diversifying. Um, one thing that I've really enjoyed from being a passive and active investor, that I'm able to invest in myself and directly diversify into other active investors across the country. So I'm geographically and market diversified, so that even if one market takes a hit, I'm still doing well in other markets. So these are questions that you really got to ask yourself and determine, where do you fit in. Now, on the other side, the passive side, this is my man Jim right here. Jim is real cool. He don't like to do much work at all. My man Jim, he like to sit back and relax. So he likes to just put his money to work and collect the check. So Jim, he likes limited involvement. He only wants to do his due diligence on the operators, and then let them, since they're an expert, let them get to work and do their thing. He only wants to play the role of the investor. He doesn't want to invest a bunch of time to delegate and be a project manager on properties. He already did his due diligence up front, and he let the other experts he partners with do their job. He has no time commitment. He doesn't. He can keep his full-time job, still doing what he does every single day, and when he get paid from his job, and he also get his partnership check coming in as well. So he doesn't have to change anything about his schedule, and he collects two checks in that regard. He's also risk mitigated. I mentioned, how I mitigate my risk within real estate. Jim here does the same exact thing. He has three different operators and investors that he works with. They're all in different markets that they operate in. So regardless of if one investment may be a little bit shaky, he got two other investments that are going great and will be overcompensated for that. And also, as a passive investor, he has the best risk reward ratio, because even if all hell break loose and the economy goes tanks and goes crazy, right? The worst that Jim has to lose is his investment. He's not he cannot be uh, he cannot have someone come after him for any type of legal aspects. He cannot come anyone come after him from any type of financial aspects. The worst case scenario Jim has to worry about is just losing his investment. However, on the upside, the reward ratio, he can double, triple, quadruple his funds in a set period of time, and at the same time doesn't have to invest anything else into the project. Well, that's the great thing about Jim. Jim likes to relax. He likes to work smarter, not harder. And I make sure I put myself in position to do the same. I like to be like Jim in a lot of different ways. So some passive investing ways that we can get involved in real estate. REITs, a lot of people are familiar with REITs, real estate investment trusts. Uh, REITs are actually outperform a lot of business stock market returns in a lot of ways as well. However, with REITs, you're investing in a business, and the business then invests in real estate. So things like depreciation per se, there aren't necessarily the focus point. So you have to the REITs have to be creative to try to allow you allow investors to participate in depreciation or just different tax benefits. And then we have mutual funds and exchange traded funds. The same exact concept applies here. Mutual funds and exchange traded funds, they're actually less favorable than REITs, but they operate in the same structure. You're investing in a business, you have a share of a business, and that business invests in real estate. Now, the next one here is syndications. We have general and limited partners. General partners are the active operators in the investment, and limited partners are the passive investors in the syndication. And then we have real estate notes, which is just the paper behind a real estate investment, right? So you think of it, I'm investing in this note. I have all my terms on it, and this note will be secured by this real estate, right? So I'm gonna elaborate a little bit more on the syndications and real estate notes uh, as well. So syndications, it's basically a partnership between a group of investors pooling their money together on a property. So think of, I have $1 million property that I'm trying to buy, but I only have 50,000. Like, I don't think the bank gonna give me that $1 million property with 50,000, right? I got to work something out. I got to figure it out. However, I know I got three friends. They all got 50,000 as well. So collectively, we got 200,000. Okay. Well, guess what? Now I created the 20% down I need to gain this $1 million property. We all go in at 200,000 collectively, and we split the profits 4 ways from there. The operating document for a syndication is typically a PPM, a private placement memorandum, which will outline all of the operators, all of the roles, positions, the returns, the deadlines, different fees. Everything will be disclosed in this private placement memorandum, basically an operating agreement, but within a syndication structure, right? And then benefits of syndications from a passive investor is passive. You don't have to actively be involved You can mitigate your risk. You have less money because you don't have to come up with the 200,000. I get the same benefits of $1 million property just with a $50,000 investment, and I also get the tax benefits. So I get a $50,000 investment, I may get 35 tax deductible, 40,000 tax deductible. I like that return. You know, you making money on the profit and and you making having less income tax. So you're making money twice on the same dollar, basically. You have passive income, diversification, and still appreciation, all of the same benefits of real estate in general. Now, case study, we're going to dive in a little bit. This is a 42 unit that I closed out in Omaha, Nebraska with a couple partners. We closed on this June earlier this year. Purchased it for $3 million. We raised $1.15 million out of 14 passive investors. So about like 800 80,000, 83,000 or so on average from each investor. Now, this property, this 42 unit, produces 40,000 monthly in income. And the LPs, their dividends are paid out quarterly, and they will receive a 3x multiplier on their money with this project. Now, going through the numbers a little bit. Now, say that same property, someone invests 50,000 out of the $1 million capital raise. They will get their initial investment back within 2 to 4 years. And the great thing is they're able to keep profiting on that same 50,000 for the next 6 to 8 years, right? So imagine I make a one investment of 50,000, but I get my 50,000 back and I keep on getting paid. This is basically what the Shark Tank investors, you know, everybody's seen Shark Tank before. This is basically the same type of structure that they invest in. Whenever their people come on, the first thing they ask is how soon before I get my money, and then the equity percentage is basically them negotiating how much will I be able to keep profiting even after I get my initial capital back, right? So this particular project we did have cash on cash. It's usually 6 to 8%. I was at 8%, and the internal rate of return was 13 to 17%. That's usually the average within the syndication market. And for those that don't know, internal rate of return is basically your rate of return over time, starting from a base zero standpoint. So think of it like if I have a 10% rate of return over 3 years versus having that same thing over 6 years, it will be a 5%, right? Because it's a longer payout. 3 years compared to 6 years. So it just rate of return with a time metric inside of it. And then the equity split on for this deal was 70-30 split in favor of the limited partners. So all of the profit, the limited partners get 70% of the deal, and the general partners, the operators like myself, we get 30% of it. So I mentioned earlier they had a $40,000 monthly income from that property. Let's say we have $20,000 in expenses just using the basic 50% rule. And with that means there's 20,000 in profit. So for someone that made the $50,000 minimum, they will receive on average a $700 monthly return out of the 14,000 that goes to the limited partners, right? So that's the 70%. So 20%, $20,000, 70% of that is 14,000. And if you made the $50,000 initial investment, you receive on average 700 per month, which over a year's time is actually over 16.8% yearly return. Okay, get what I'm saying? That's a 16. If you made the minimum investment, you will be making a 16.8% yearly return. Now we went through what the banks give you, 0 and 0.1. We went through what most investors get in the stock market, 5%. On this particular deal, as a limited partner, you're receiving 16.8% return. This is how the wealth gap is created. This literally right here, we got the people that's at the top of the wealth gap, are getting 15+% yearly return. Whereas the people that are not at the top of the wealth gap, they're stuck getting, or they're keep on going back to their 0.1%, their 0.1% in the bank, or their 3, 4, 5% in the stock market or their retirement account. And that's just the first year. When it comes to 10 years, a decade, then you got a multiply of that, right? So that is syndications. We're going to pivot into promissory notes. Promissory note is basically just a debt instrument that is a promise of the borrower to repay the lender a specific amount of money at a certain time at a certain future date. Now, operating documents, some people may not think they're in a promissory note, but do you have a mortgage? I mean, do you have a car note? Have you ever had a construction note, a hard money note? You signed a promissory note. You were simply on the receiving side of the promissory note as a borrower. So your mortgage in those 100 pages that you had to sign to sign over a house, a promissory note was in there, and you had to sign to show that, okay, I promise to pay this lender or this bank back this rate, this amount of money at these particular installment amounts. Same thing for your car. So as in addition to that, now there's also about the real estate mortgage industry is about a what is it? 100 billion industry, $100 billion lent in mortgage industry. About 6% of that is actually private lending. So a lot of investors, another reason the wealth gap is being created, a lot of private individuals, they take on the role of a lender, and they lend out to other investors capital at whatever terms they negotiate, and they get a return on that money. So the benefits is it's passive. And it's secured risk. It's a legal document with the promissory note. Even if you default, like the bank, just like if you don't pay your mortgage, then guess what? The bank can foreclose on that, keep the money you paid them, take back the asset, and sell the asset for more profit. It's a win-win. They cannot lose. So understand the role, going back to the employee versus investor mindset, the role of an investor. I'm using this legal document to secure my money, so no matter what happened, I'm guaranteed to win. That is how investors, the true wealthy, the 1%, actually operate and think. No matter if the market going up, the market going down, I'm always secured and having my money create more money. There are also greater yields, there's steady returns, and there's a flexible funding requirement. You don't have to, you can lend out a promissory note on, I've seen 40,000, 20,000, 50,000, or $1 million in promissory note investments from private investors. So you get that added benefit of a flexible funds requirement, whereas on the syndications, most syndications require a $50,000 minimum investment. But promissory notes allows for a little bit more flexibility from an investor standpoint. So let's do a case study on a promissory note. This is actually a standard promissory note for myself. List the date, list the borrower name, lender name, the address, the dollar amount. You have the payment. So when it's due date, you establish the due date. You can say if it's a lump sum or installments. So lump sum is simply just saying this is the amount of money, and at the end of this time period, say 6 months or 12 months, I want all of my principal back and the interest, whereas versus installments is what the bank typically does. So you have it's amortized over 30 years, and you have monthly installments to pay. That's how a mortgage is typically structured. So you have a set monthly amount that you're paying. You have the late fee extension option if you choose to extend it, and then security. Look at the bottom. Security is unsecured versus secured. This is what, for me personally, I always do secure, is always secured by some property. And this is also what banks do as well. They secure their promissory note with the house you're purchasing. So that's how they're able to foreclose and legally take back that property, because the promissory note is secured by the property you're buying. So the steps to really, once you if you want to be a promissory note investor, the steps to really go about that process is just finding a trustworthy borrower, something or someone you want to invest in. Determine all of the terms, whether it be the amount, installments, date, etc., and sign the documents, send the money, and receive the note. So it's an exchange. You send your money in exchange for the promissory note with all of the terms, and it's their promise to pay back. That's why it's a promissory note. And for me personally, I made $50,000 in 2 months off of a promissory note. Now, some may say $5,000. It don't seem like a lot, but in actuality, the the average person spends, the average family in the United States spends $5,000 per month. So, I mean, just from this one promissory note, I didn't cut my yearly expenses from 12 months down to 11 months, just from this one. Now, let's say I do 12 of these. I have covered the entire year's worth of the average spending amount of a family just by doing 12 of these.
Yep.
And this is the mindset you have to start establishing, though, to make sure you're on the top side of that wealth gap. Because the trust and believe, the wealthy and the 1%, they thinking, how can I put my money to work to eliminate and cover all of my expenses? And that's really when you become financially free. Your passive income. Financial freedom is simply having your passive income being greater than your expenses. That's it. And it doesn't really take a lot. Like, guess how much you spend per year at the 5,000. That's just $60,000. Can you put your money to work to create $60,000 in passive income? It's a lot easier. It's a lot easier than you think, especially when you leverage and acquire real estate to help you get there. It only takes a few properties to create that yearly income for you passively.
It's a great case study, and some would say that going ahead and like you said, you know investing in a note to create, or in several notes to create 60K would be much easier than if somebody was to go to their boss at their W-2 and ask them for a $60,000 raise. How often is that going to happen? And
Yeah,
it's not for most people, right?
yeah. I mean, personally, I don't know anybody. So I'll tell you a story. I had a crazy, when I was working as an aerospace engineer, I had the most insane pay raise ever. I switched companies, so it wasn't with the same company. So it was through negotiation, but I went from making $100,000 a year to $150,000 a year. I had
Right.
a $50,000 pay increase, and it still wasn't 60,000. So understand, even at the 0.1% of pay increases, you still will not be able to create some of the passive income or the upgrades in income that you can by having an investor mindset and using the strategies and vehicles that are available to you, which only become knowledgeable if you seek them, attending meetups and conferences, talking with Chris, talking with people like myself, to where we will be able to present opportunities that you can create that extra income and passive income for yourself. So let's talk about some note investment by the numbers. So a $50,000 investment at 12% is $56,000. So that's a $6,000 profit. As I mentioned for the example prior, I made $5,000. The average person the average family only spends $5,000 a month, right? So $250,000 investment at 12%, that's 30,000. Now the median income per year is 40,000 and some change in the United States, the median income. So I just from one $250,000 investment at 12%, I basically replaced the average income of the average family just from one investment. $1 million investment at 12%, obviously 120,000, I mean, where now I'm taking it even that much more to the next level. So let's say a 50, everybody familiar with the rule of 72, right? How long it takes for money to double. You just divide 72 divided by whatever your interest rate. That's how many years it will take for your money to double. So at 12%, that's 6. So my 50,000 can go to 100,000 in 6 years. For myself, I actually got out of I transferred my equity account because when I was playing football, I started a stock market equity account. And it's been 8 years and my money still did not double. It was growing at the 5-6%, like we talked about on the first few slides. I'm like, this is not working. Whereas on the real estate side, I've been in real estate for going on 20 years, but I've been investing for about 4. My personal investments within a couple years already had doubled. So do you want to double your money over 8 to 10 years, or do you want to double your money every 2 to 3 to 4 years?
Yeah.
I'll person choose the shorter time. Me, I don't want to sell myself short. So I transferred all of the equity account and invested it into more properties. 100,000, same thing, goes to 200,000 in 6 years at the same 12%. So now you're seeing the trend. Now this is the same 50,000. I didn't have to reinvest another 50,000. My 50,000 went to 106 years, another 6 years, which is 12 years total. Now it's at 200,000. Now I'm keep on repeating it. Do you know a $50,000 investment will turn into $1 million in 26 years? Just one time. I'm sure everybody, the average income is 40,000. So I would imagine most of the people here in at least 40% of the country make 50,000. So being able to save $50,000 to invest one time will turn into $1 million within 26 years if you don't do anything else. Now, do you know if you invest 50,000 every 3 years at 12%, now you have $1 million in 7. Forget 26. I would rather have $1 million at 7 years than 26 years. So you see how the scale, the economies of scale is not addition, but it's multiplying. It's dividing the amount of time it takes just to get to that 7-figure, 8-figure mark. The more I can invest and have my interest reinvested, compounded interest, right? Everybody familiar with that term. So that's really where I seek, and I hope you seek, as I just said, $50,000 investment will turn into $1 million within 26 years. So really the question that you really need to ask yourself is this: who do you need to become to maximize your return on investment, be a 1% investor, and also be at the top of the food chain or the top of the wealth gap? Does anybody know? Can anybody tell me? Can anybody? Any suggestions? You need to become the bank.
Oh, there you go.
That is the answer. Become the bank. That's literally what the bank does with your money. The bank doesn't even have any money. They take your money, appreciate you for that. Here's your 0.1%. Be happy. I'm going to take this and go triple this real quick over here and lend it out various different investors and keep all of that profit. So basic financial arbitrage, taking a amount of money at a low interest rate and lending it out at a higher interest rate and keeping everything in the middle. This is what banks do. This is how they're able to get a 16 plus X, a 16X return on your capital. and they give you 0.1% of it. Like, I don't know about you, but I don't want the bank getting rich off of my money. You know what I'm saying? It's not, I can see if it's their money. They using my money to go get wealthy and leaving me the crumbs. I'd much rather take my money, invest it directly, and keep all of the profit. I want to put my money to work for me, not for the bank to get wealthy, right? So that's again going back to the mindset. That's very, very foundational from an investor versus just an employee and just leaving my money in a bank account, right? So that's really what I focus on over at Financial Athlete Capital, prioritizing wealth and health, helping current former athletes as well as other professionals work with engineers as a former engineers as a former engineer, just to build their passive income through real estate investments, optimizing knowledge network, because that is what creates opportunity. Your knowledge and your network. I always say the two things that will maximize your growth in life is your knowledge and your network. So you want to seek and expand those daily. Now, once you start doing that, then you have opportunity. So simply it's a matter of execution. Preparation meets opportunity. That's the winning formula to life. So your knowledge and network is your opportunity. Executing on those opportunities will lead to the winning formula. This is simply a QR code to scan. You can connect with me on one-on-one calls. You can go into my calendar. Also on all social medias. The number one Scioneaux, Cioneaux, my last name. A1 Scioneaux, or you can go to imperiumfortune.com or financialathletecapital.com to get in contact with me as well. I'm always releasing content, YouTube, Instagram, and so forth. So appreciate Chris, appreciate the time. Thank everyone for listening. Hopefully, you gain some value, gain some insight, and I'm open to questions.
Alvin, excellent, man. Thank you very much for taking us through this. Yeah, it was just packed with information. I will tell you, this is the first time that anyone has covered on note investing, and that's such a powerful tool. A lot of people sleep on note investing. Not for everyone looks at multifamily and short-term rentals and all those types of things, but I mean, when you think about passive investing, man. I think it probably can't get more passive than that.
Absolutely, absolutely, and it allows for a lot more flexibility. Is probably the main thing, because whereas in the syndications, or you're in that investment, you're in that structure, uh, the minimum, whatever, usually 50,000, you're at that minimum. Whereas with note investing, if someone only needs 10,000, or any higher or lower amount, you have the flexibility to structure the terms however you want. That's the benefit of a note investing as well. Whereas syndications, you're stuck to whatever is being offered. The options available. Whereas with notes, you can negotiate the terms as you so please.
Absolutely. Well, let me do this. But first, before I get into the final questions that we ask all of our guest speakers, when they come on the show, I want to just open it up to anyone out in the audience to ask any questions that they may have. Otherwise, I'll jump right in and start asking. Well, let me jump in and just ask a couple of questions, Alvin. Like this, I'm going to put you in a hot seat for just a quick second. I
Okay.
love making sure that we could take the opportunity to ask questions of our investors or of our guest speakers to really help everyone get to know them a little bit more beyond what you shared already with us today. So one of the main things that my family and I love to do is travel. We enjoy traveling. We've gone to some great places. As a family, we've done some things individually, but I want to know from you, what is one of the best trips that you've taken, and why is that?
Okay, so this answer is a very easy answer. There's no even close second. Okay. the best trip I've been on has to be when I went to Jamaica, the Caribbean. I had over I had 160 people go with me.
It's
And it was because it was the wedding to my wife. So we had a destination wedding. You know, people, destination weddings are typically 30, 40 people, something like that. We had well over 150 people attend from all over the world, uh, United States, Europe, various countries in Europe as well, um, and Middle East, all came out to Jamaica to enjoy our wedding. It was a great time. We stayed there for a week plus, and did our honeymoon elsewhere, and it was a great trip overall. Definitely a great time. Thanks to my wife because she did all of the planning. I did all of the funding,
yeah,
and together we made a great team.
that's right. What an
So
awesome
yeah, that
trip, man. No, no,
yeah, that
that's
would have to
great.
be it.
Where in Jamaica?
We went to Ocho Rios.
Right.
They're real big. They have a lot of we had an all-inclusive resort out there. We did a bunch of the excursions. They had the 8 rivers, all the different waterfalls. Went to the lagoon that glows at nighttime when you swim in it. Like that was pretty cool. Four-wheelers. And then I did a whole bunch of surfing. I felt like I was Aquaman. I was doing windsurfing, surfing, like all kind of stuff in the water. It was
Oh,
nice.
oh, I love it. Yeah, that my family, my father's side is from Jamaica, and we actually brought the kids and the family out to Jamaica as one of our favorite trips as well. Just a couple of years ago, actually, right before the pandemic, we went out there and it
Nice.
was we hit up Ocho Rios as well, and it was just great. So I'm so glad that you had a great time, and that definitely marks one of the great trips right there. Um, the next question I want to ask you is, what you clearly have a lot going on. You even had a chance to share some of your case studies, both on the multifamily side of things of a project that you guys closed on this summer back in
June.
Nebraska in June. And then, of course, you have something that you actually just mentioned earlier that you recently closed
Yeah,
something in
yeah, we closed
California.
something today. Yeah,
Yeah,
we
what you
closed
working
today.
on? What are you
Yeah, we
working on these
closed
days?
6 unit today in Hollywood, California, that we're going to add 2 units to. Um, and that one was crazy just from being in California with the insurance aspect that's going on, debacle. I know Texas and Louisiana and Florida going through some of the same things because a lot of insurance companies are losing money. So I know particularly in Louisiana, like the insurance has tripled just in the past couple of years, and same thing with Florida, Texas. So with California, it's because of the fires. A lot of the southeast is because of the hurricanes and flooding and everything. So just in general, it was a rough one, but we raised on it. We got some investors on it. We actually still have a little one last slot left for any passive investors that are interested in. I can send you the investor overview on it, but we just closed it today, and we're looking to start the value add implementation on it here as well. So looking forward to it. It was a great project. We got it for it was a foreclosure. We got it for well undervalued, like beyond it. We got it at 1.27 million and it appraises for 3.1 million, just to give you an example. So we got well over $1 million in profit, a lot of great potential. Excited to get started on that one.
Beautiful. What an awesome deal, and would love to learn one day, how you guys found the deal and put everything together. I think this is that's awesome. But like you said, in terms of bridging the wealth gap and how wealth is created, finding things and being savvy and knowing the markets. A lot of people talk about markets. It's so interesting. Which markets do you focus on? A lot of people will say, "Oh, I don't do anything in California." But when you know your market, like the market, and people can make money anywhere. And so I think that's super, super awesome stuff right there.
So, and to piggyback on that, people need to the 1%, the wealthy mindset, notice there's really only one thing that's risky in life. Like there's no such thing as, oh, Bitcoin or real estate is risky or California is risky and all this other stuff. The only thing that's risky is the investor. The investor is lack of knowledge. That's the only thing that's risky. Because if you know something is a good, so if you know this option is a 1% return, the second option is a negative 5% return, and the third option is a 10% return. If you have the knowledge of knowing the best option, I'm gonna just choose the third option every time because I know that's the best option. Whereas the investors who don't have the knowledge or don't have the expertise or due diligence, then they get stuck. Or let me just choose option one. And oh man, I got 1% return. Inflation is killing me. But that was the investment the whole time. It just you didn't have the expertise to fully flush out, or the people that chose the second option. Like, dang, I lost some money. It wasn't the investment that was bad. You just didn't have the knowledge to see clearly on all of the risk and um, the end result for that particular investment, right? You follow me? So it really, the individual investments themselves, they will be what they're be. It's like saying the sky is blue. Like, okay, the sky gonna be blue regardless. It's a matter of you fully understanding and fully seeing the investment all the way through and knowing what's the most risk averse option. So it's really the individual investor. That's why I always say, like I said, knowledge and network. Knowledge
Yeah.
and network, two things you always want to expand to maximize your opportunity and impact in the world.
Powerful.
Let's
The
see.
last two questions that I have really here are as follows. The first one is about financial freedom. You talked a little bit about it during your presentation, but what does financial freedom mean to you?
So financial freedom for me is simply, I go with the base definition first, passive income being more than your expenses. But beyond that, it's just simply a matter of being able to do what, when, where, why, how, whenever you want. That's having the ability, having the excess cash flow to, if you want to go take off, then having that excess cash flow to do that. If you want to go take a trip to Jamaica, the Caribbean, or Africa, Europe, Asia, wherever, then you have enough income and funds to go do that. Just being able to, if you want to not work, not having to uh, check in with take PTO, or not having to, okay, I can't do it right now because I got this business I'm running, or whatever the case may be. Just having options. That's really, at the end of the day, from a foundational level, financial freedom is just simply having options.
Last question. The name of the show is called Wealth Mindset and Real Estate Investing. But what does having a wealth mindset mean to you? You talked a lot about mindset too, so I think you got some. I think you're connected here too.
Oh yes, yes. I mean, so mindset is very, very foundational. I mentioned before, everything that ever existed started as a thought. So think of your thoughts like seeds. No matter what you plant, no matter what kind of seed you put in the ground, as the tree grows, you're gonna see what was planted. I can see an orange tree out in the yard. And I'm not gonna be like, dang, I wonder what kind of seed was planted. The the fruit, a seed is determined by the fruit it bears, right? So, as I always say, the your results in your life, the the different components and opportunities in your life are simply a reflection of how you think. So, I mean, I can get biblical, but as a man thinketh, at, as a man thinketh, so is he, right? So, just understand that if you want to change anything about your life, you first need to change your thoughts, no matter what it is. So that's foundational. I'm real big on mindset, just to not get myself too down or too low or too frustrated or too upset or too sad or anything of the sort, because I know, once this is affected on a negative way, then guess what the rest of your life gonna be? It's gonna be following suit,
Yep.
going that negative trend. So I'm real big on mindset.
Powerful. Well, Alvin, thank you so much for being here, for taking your time and walking us through this. It was a powerful presentation. I learned so much. I'm sure everyone watching here live learned so much as well, and as well as the folks that will be watching the playback on the recording. For those here and for those watching the recording, how can they get in contact with you?
Yes, yes. So I'm on all social media. Uh, the number one Scioneaux, Cioneaux. So A1 Scioneaux. Or you can go to website financialathletecapital.com. That's actually a link on there for my passive real estate investing guide. Have a bunch of layouts, opportunities, a bunch of different questions, due diligence questions in there that you need to ask, different things that you need to be thinking about as well when investing from active and passive side. And then also you can go to imperiumfortune.com, Imperium Fortune, Imperium fortune.com. And that's the advisory firm I have with my wife, who's an attorney. I basically focus on the asset growth of everything, and she focuses on the asset protection. She does a lot of estate planning and trust and wills, marital agreements, all of the asset protection, business documents on that side. So it's twofold. You got to build the wealth and protect the wealth at the same time. So we kind of tackle that one together.
Well, thank you very much for your time this evening. Thank you all for joining this evening. I really appreciate you. Look forward to catching you in the future. All right, take care.
Oh yes, appreciate it, Chris. Had a good time.
Thank you.